Are you dreaming of owning an apartment building, but kind of lost on the financing side? Well, guess what? You're not alone. Apartment loans can seem complex, but fear not. I am Roderick Jones. I'm a multifamily capital advisor with Apartify, and today I'm going to be your guide through apartment loans. So, whether you're a complete beginner or just need a refresher, this video is going to break down everything when it comes to apartment loans. So let's get right into it. So what exactly is an apartment loan and how do they differ from single family loans? Unlike a traditional single family mortgage that you will buy as your primary residence, an apartment loan is a loan specifically designed for buying rental properties. So when we look at apartment loans, most of the time you're not buying an apartment to live in. You're buying an apartment as an investment property. So the difference between an apartment loan and a single family loan is a single family loan is a loan where you buy as your primary mortgage. And then an apartment loan is a loan that you get when you are buying an investment property. So single family is used as your primary mortgage. And then apartment building loans are loans specifically designed for apartment buildings that you are going to use as an investment vehicle that's going to generate some type of rental income for your portfolio. So why do people use apartment loans? So most people get apartment loans. So when doing a multifamily deal or doing an apartment deal, most of the time, there is going to be some form of leverage used, meaning that you're going to get a loan. Most people don't pay cash for their apartment buildings. I know, that's surprising. But majority of apartment deals are financed using debt. And this is where you get an apartment loan. So when you're going to get an apartment loan and you know you're going to use debt, most people use two types of financing, or they use two types of loans when buying apartment buildings. You have short-term financing, and then you also have long-term financing. And so what is the difference between short-term financing and long-term financing? The difference is this. In the short-term financing category, there are normally two types of loans. You have bridge loans, and then you have construction loans. Now, we'll go into the details of all these different loan products on future videos, but just for this video, we're going to keep it very high level. So short-term financing, you have bridge loans and you have construction loans. When you think of short-term financing, I want you to think of using a loan to do some type of renovations or get the property up to speed. So when you use a bridge loan, 9 times out of 10, the property is going to need some work. You know, you're going to use a bridge loan to do some type of work to the property, whether that's renovating the units, whether that's leasing up the units. It could be a lot of different things, but you use a bridge loan to do some type of renovations. And then next, you have a construction loan. And when you think of construction loans, I want you to think of doing some type of renovation to the property. So you're either going to build it from the ground up, you're going to add additional units, you're going to do something where you're building something. So when we talk about the short-term financing category, you're doing something to the property. So most people get short-term loans to do something to the property. If you get a bridge loan, you're getting a bridge loan because you want to renovate something. If you do a construction loan, you're getting a construction loan because you want to build something. And so that's where most people get short-term loans. Then we step over to the long-term financing category. And when we talk about long-term financing, you're not necessarily building anything or renovating anything. The property is already done, meaning that they have already done the renovations and you're just coming in to hold it as a long-term investment. And so when you talk about long-term financing options, some of these options include agency financing. And when we talk about agency financing, we're normally talking about Freddie or Fannie. You'll hear that in the industry. Of course, we're not going into each of these. We're going to do that on future videos, but just keep it high level. We're talking about Freddie or Fannie, which is agency financing. You have life insurance company loans, which is where a life insurance company provides you a loan for a property. You have CMBS loans, which is commercial mortgage-backed securities. And then you have bank loans. So long-term financing, you have all of those all of those 4 different categories that you can go into to get financing. So let's wrap this up. So anytime you look at short-term financing, you have to do some type of improvement to the property, whether that's construct the property, whether that's renovate the property. You have to do some type of renovations when doing short-term financing. And then when you're doing long-term financing, everything is already in place. The property is already leased up and you're just buying it and you're holding it for a long term, meaning 5, 10, 15 years, maybe 30 years into the future. So let's move over to the key factors that you need to consider when looking for an apartment loan. So most lenders are only looking for 3 things when looking for an apartment loan. They're looking for track record, they're looking for net worth and liquidity, and they're also looking at the property and making sure it can hit the DSCR, also known as the debt service coverage ratio. So let's go into the first one, which is your track record. Lenders want to see if you have done deals that look like the deal you're currently getting financing for. So if you're going in and looking to finance a 10-unit apartment building, they're going to look at your REO, which is known as your real estate owned. And this is basically a spreadsheet that shows all of the deals you've done, and your ownership percentage in each of these deals. And if you want an example of a REO, you can go to partyfi.co/REO and download the REO template. And you can use this template to start filling in your REO schedule. So they're going to look at your REO schedule to determine what is your track record. Have you done deals like this before? And then your question is, if you haven't done deals like this before, what do you do? Stay tuned because we're going to focus on that in another video. But for this video, first thing they're going to look at is your track record. Make sure you have a track record doing deals of a similar size. So if you're doing a 10-unit deal, make sure you have a 10-unit deal on your REO schedule. And if you don't have a 10-unit deal, they may ask you for, higher down payment or something like that. Next thing they're going to look at is your net worth and liquidity. So if you're doing a $500,000 deal, they're going to want you to have a $500,000 net worth. And they're going to want to see your down payment. So are you raising the down payment? Is the down payment coming from your retirement account? Is it coming from your personal account? Is it coming from your savings account? They're going to make sure you have the net worth to do the deal. And they're going to want to make sure that you have the down payment. And most down payments for when financing an apartment deal is anywhere from 30 to 25%. Now, you can get higher leverage when you start doing structured finance and structured products, and we'll talk about that on another video, but expect to pay anywhere from 30 to 25% down. And then lastly, they're going to look at the deal itself. If you're already buying a deal where it has where it's already stabilized, meaning that you're buying it for long-term financing, they're going to make sure your DSCR, also known as your debt service coverage ratio, hits a 1.25%. And then if you're looking for some type of bridge loan or anything like that, most bridge lenders don't have a DSCR requirement, but if they do, it may be 1% or more. So that's something you need to consider.